Good evening, and thank you all for coming today. My name is Matt Murphy, and with me are Colt Wolfram, Mike Pachucha, Phil D'Entremont, and Apo Agbamu. We are from the University of Minnesota-Duluth, and we are very excited to present our analysis of Graco Incorporated. So based on slowing economic growth in key foreign markets, foreign currency effects, domestic acquisition challenges, and lower demand in the mining industry, we are presenting a hold recommendation with a price target of $70, which represents a 5% downside from the closing price of February 10th. Graco operates under three business segments: the industrial, contractor, and lubrication segments, with primary end markets in the Americas, EMEA, and Asia Pacific. The industrial segment represents 59% of total sales and has grown operating earnings at a 9% CAGR over the since 2009. The contractor segment represents 31% of total sales and has grown operating earnings at an 8.9% CAGR. And finally, the lubrication segment is 10% of total sales and has grown operating earnings at a 12% CAGR going back to 2010, with negative $3 million in operating earnings in 2009. The board of directors has 8 members and oversees the audit, compensation, and governance committees, as well as the management organization. 87% of shares outstanding are held by institutions, which leaves 13% to free float. Patrick McHale is the CEO and has been with the company since 1989. CFO James Grainer has been with the company since 1974 and will be retiring this year. And Charles Rescorla is the Vice President of Corporate Manufacturing, Distribution Operations, and Corporate Development, and he's been with the company since 2003. The management team is compensated through a combination of base pay, bonus, and stock options, with a small percentage coming from other sources. Now I'll hand it to Colt to talk about the industry overview.
Thanks, Matt. In our analysis, we used the S&P 400 Industrial Machinery Index as a benchmark to the industry. We found that the industry as a whole is highly correlated to economic activity. More specifically, we found that the index has a 0.94 correlation to US GDP per capita. We also found that new product development drives growth within the industry, and that Graco has consistently had a higher research and development expense relative to its peers. The company actually aims to have 30% of sales in a given year come from products developed within the last 3 years. We found that one of the highest barriers of entry within this space is actually the cost-intensive capital of the industry. Graco is a market leader in the industrial and contractor segments, and Graco currently has 25% of the market share in the industrial segment and 58% of the market share in the contractor equipment segment. Graco primarily uses 2 key initiatives to enter into new markets. The first is through geographical expansion. Graco currently has a 23-person sales team in South America, and another initiative is through new product development. The company, an example of this, has recently introduced the TrueCoat 360 paint sprayer to break into the do-it-yourself paint spraying market. Relative to Graco's peers, Graco has higher gross operating and net margins than all of its peers, except for Nordson, which posts a higher gross margin because Nordson distributes and markets products directly to its customers. I will now introduce Mike to go over our investment thesis.
Thank you, Colt. We look at our 4 investment highlights we believe will create macro headwinds for Graco the coming year. First is slowing economic growth in key foreign markets. We're broken down into 3 areas. The first being Japan. Japanese GDP is expected to decline by 0.5% in fiscal 14, and that ends in March this year. Next area we looked at is China. Chinese GDP is expected to grow at 7.4%, which is the slowest in over 2 decades. And the third area we looked at is the Eurozone, which has struggled to reach pre-recession levels. Our second highlight that we looked at is the US dollar appreciation versus foreign currencies. This is going to affect Graco in 2 ways, both translation and slowing exports due to Graco producing most of its goods within the United States. Management has stated in the last earnings call that if the currency markets stay where they are right now for the rest of 15, that they expect to see a 10% hit on earnings and a 4% hit on sales for the whole year. The third highlight that we have has to do with domestic acquisition challenges. First 2 acquisitions that we looked at were Guzman and Glasscraft in 2005 and 2008. These 2 companies were acquired in the facet equipment market, and the FTC regulated that Graco was eliminating competition by dealing with distributors and pricing the products higher than competition could. Second acquisition that we looked at is the ITW liquid finishing acquisition in 2012. And again, the FTC stated that by this transaction that Graco eliminated competitive forces within that particular market. And that acquisition is stated to be divested, and that should close in the first or second quarter of 2015. And the fourth highlight we looked at was lowering demand in the mining industry. As we see material prices decline, CapEx is expected to decline as well. The 10 largest mining companies in the world increased CapEx from 2012 to 2014 by 21%, and they're expected to decline that again in 2015 by another 10%. As demand in this area declines, we expect this to impact Graco's lubrication segment. Now I'll hand it off to Phil to talk about the financial analysis.
Thank you, Mike. Going on to the financial analysis on the income statement, we want to talk about the net income available to common shareholders. We have this growing at an 8.2% CAGR going from year-end 2013 to 2020 based on our financial findings, which I will talk about later. Onto the balance sheet, we want to talk about the ITW finishing brands, which it will be held at a separate company, which will be held on the balance sheet, which will also eat away at the return on assets and return on equity. Graco has typically averaged a 3.6 current ratio and a 2.9 quick ratio over the last 5 years. And we believe this leaves Graco as a financially sound company. However, this will, again, eat at the return on assets and return on equity. Graco also has an underfunded pension fund, which they have had since 2007, due to an 80% base and 80% weight on equity in the pension fund. Due to the 2007 bear market and Great Recession, this has reduced the pension fund, and they have now since shifted to a 65% weighting, which we believe can force involuntary contributions from Graco in the future if there were to be a market turndown. With the divestiture of the ITW finishing brands, Graco will also have a large cash inflow coming in 2015. Management has stated that 4 main uses for this cash. First will be share repurchases, repurchasing shares down to 60 million diluted shares outstanding or less, to reduce debt to 300 million, to go through acquisitions as they see fit, and increase dividends to shareholders. It's currently at between a 30 to 35% payout ratio, and management intends to keep this at 30% going forward. Graco also has a 2.8 capital expenditures to sales over the last 10 years as an average, and cash flow we expect to see grow in 2015 due to the divestiture of ITW. And now on to Oppo for the valuation.
Thank you, Phil. Due to the cyclical nature of Graco's business, we broke our discount cash flow to firm model into 2 3-year growth stages. In the first stage, we really see the Americas region being the main driver of growth, and the EMEA and Asia Pacific region slowing down due to the global economic conditions there. In the second stage, we see that picture changing, and we see the EMEA and Asia Pacific regions being the main drivers of growth, and the Americas region beginning to taper down. We have the growth in the second stage growing by 9.8%. Some other factors to take into account when looking at our discount cash flow to firm method are the perpetual growth rate and the required rate of return. The factors that we took into account for the perpetual growth rate were global economic conditions, the company's ability to generate strong organic growth, strong cash flow generation, and currency fluctuation. Due to the artificially high cost of debt and the artificially high cost of equity and the artificially low cost of debt, we took an alternative method in generating our WACC. We took the historic return of the S&P 500, took the current 10-year bond yield and factored in a 1.7 risk premium, which is equal to inflation, and arrived at 11% WACC. Some secondary valuation methods we used are EV to EBITDA. The EV to EBITDA method helped confirm our $70 price target on Graco. Taking into account market sentiment, we used PE, and the $80 price target we reach here really shows a limited upside we believe is associated with Graco in 2015. And lastly is Monte Carlo analysis. The data was highly skewed to the right, leading us to believe that there's a higher probability that Graco will finish under the mean price of $81 in 2015. Some investment risks we considered are the U.S. housing market. If housing starts were to show robust growth, this would be very good for Graco's contractor segment. If interest rates were to rise, this would affect both Graco's cost of capital and its end users. If end user conversion were to pick up in the EMEA and Asia Pacific region, this could potentially offset some of the slowing growth that we expect there in our first stage. And lastly is price sensitivity. Graco typically raises prices by 2%. If customers were able to find an equal substitute for their products, this could potentially hurt them going forward. In conclusion, we have a whole recommendation on Graco. From its closing price on February 10th, this represents a 5% downside. Some highlights associated with this recommendation are slowing economic growth in key foreign markets, foreign currency effects, domestic acquisition challenges, and lower demand for the mining industry. In closing, we would like to thank everyone for coming out. We would like to thank the CFA Institute for hosting this event, and we would like to thank our mentors for helping us throughout this process. Questions?
Thanks, guys. During your analysis of Graco, did you guys at all kind of assess the value or the quality of Graco's management team and how that play into your recommendation?
So one of the things that we liked about the management team, especially speaking to Pat McHale, he's been with the company since he was 18 years old and really understands how the company operates, really worked his way up. And also with Mr. Grainer, who has been with the company since 1974 and managed the costs phenomenally. And we understand that really the operating costs are one of the big drivers of the bottom line here is managing those operating costs, and we think that they've done a good job of that thus far.
I'd like to ask a financial modeling question. It looks like Graco's had trouble getting margin expansion here recently. In your model, especially going up to 2017 and 18, has pretty good margin expansion. What is the biggest drivers in your assumptions, and what factors could cause that to go the other way?
Due to the operating leverage that's inherent in the business, we feel that once production volumes increase in that second stage, that'll help margins expand in that second stage. In the first stage of the model, we don't expect production volume to be as high. As a result, margins are contracting in the first stage. So the biggest reason is the operating leverage that's inherent in the business.
They are disclosing of the liquid finishing business and getting proceeds of about $570 million. How do you factor that into the outlook of the company, and what adjustments, if any, did you make to your evaluation methodology?
Right now they have about $430 million approximately on their book as short-term investments, and then they have the 570 coming in. So in our valuation model in 2015, we adjusted the free cash flow by the difference to show that influence in the model, and then that in turn factored into the overall cash flow throughout the model. Was there a second part to your question?
So as one of your points in labeling the company as a whole, you talked about lower demand from the mining industry. A couple questions within that. One, what percentage of overall sales does the mining industry represent? Did you guys calculate or attempt to calculate sort of the economic hit that's in terms of what percentage of their operating profit would be exposed to this prolonged slowdown within that industry? And then lastly, are there segments of their business that you think would benefit from declining input costs? You know, whether commodity prices across the board decline and then that spurs greater housing demand, lower input costs. How do you guys think about that?
Sure. So for the first part, lubrication for Graco is about 10% of sales and about 7% of net income. So from the whole business, we put it on there to better understand the whole business, but we understand that it's not the largest segment of it. And then for the second part, we believe that we're seeing lower commodity prices, but if the demand isn't there on the customers buying it, we believe the input side of the business isn't going to be as strong as an effect as the decreased demand from the other segments.
And to add to that, we actually spoke with one of the suppliers of raw materials, and it was E&J Corp, based in Blaine. And what they said was that they had to project their Graco's orders 26 weeks out. And for aluminum prices, since aluminum's been increasing, Graco will actually, they won't necessarily benefit from these declining commodity prices.
You mentioned in your, I think the first person who introduced the story talked about cash compensation for executives. And we spent a lot of time in the proxy statement trying to understand management's incentives, what they're focused on, what's tied into what type of operating metrics, how much stock they own, options, restricted stock, things like that. Can you talk about management's compensation on a short-term and long-term basis, and what metrics they are focused on in terms of returns or earnings per share, and how that factored into your valuation analysis or analysis of the company?
as Matt mentioned, management is compensated through base pay, stock options, and then other forms of compensation. A big driver for Graco is cost management. When we're down during Analyst Day, they actually mentioned that there are pay incentives that are tied to cost management across the company. So I believe that's a big driver for the business. That's why they've been able to typically grow their earnings faster than their revenue. And then that tied into our valuation as well, and the gross and operating margins. During our first day, we really didn't have much fluctuation. So due to the company's ability to manage those operating costs in the first stage, we held operating costs constant because we believe that the decrease in volume, the company's ability to manage their costs would be realized with slowdown in production volume. And then in the second stage, we also have their operating costs staying constant again to reflect our belief that the company has a good ability to manage those operating costs.
Second question, just briefly, is Graco's made 9 acquisitions in the last 24 months. Can you talk about the price they paid on a multiple basis and whether or not you think those acquisitions were they paid, they overpaid or they underpaid?
We do not have the multiple basis. However, the last 4 acquisitions that we've seen have demonstrated kind of our argument about the domestic acquisition challenges, as 2 of the 4 have been in Latin America and Canada. And so we're seeing these acquisition challenges coming through in that these acquisitions are relatively small. So those 4 together are combined to be $185 million, and one of them was a total of $160 million. So we're seeing that pipeline is getting slightly narrower.
Just to follow up on that, management also stated in their recent earnings call that they expect the 4 acquisitions to be accretive in 2015 by about 13 to 15 cents. So from that instance, we don't believe that they overpaid because they're going to have a direct impact on the company's business in 2015. So from that perspective, we would say that it'd be a benefit for the company going forward.
One of the things that my firm spends a lot of time on is assessing the company's durable competitive advantage, and I see that you guys did a 4-5 forces in your analysis. Can you maybe judge or maybe rate for me Graco's, in your view, Graco's competitive advantage versus its peers, and also how that score or ranking or however you saw it, did that factor at all into your evaluation?
I'm sorry, could you say the first part again? Just the
Yes.
first part, that's all.
Right. I was trying to say, I'm asking for kind of an assessment of Graco's competitive advantage versus its peers, and also how they kind of factored into your evaluation.
Okay. Yeah, so on the contractor segment, Graco's products are seen to be of higher quality, they last longer, they're higher priced because they're more targeted towards the commercial market. That's something that we found out when we talked with some people from Sherwin-Williams and Home Depot. Those are some of the major distributors for Graco. As far as maybe the industrial segment, Graco, when they introduce products, they tend to kind of, add on to other products that they have, and they only work with Graco products. So they kind of create this, very competitive advantage within the industrial segment as well.
Yeah, just to follow up on that, another big thing with Graco is that they have a lot of brand loyalty, and the company's well known in the industrial segment. When they give a product to a distributor, they typically have like a 1-year period where they will typically work with the distributor, and then in the contractor segment, as Cole touched on earlier, they're a premium name in that space, so that gives them that advantage as well. And now that they're in 2008 and 2009, they started lowering down their prices to kind of get more market share in that sense. And then now they are adding on a higher, they were unable to really raise the prices on those lower priced products. So now that they're introducing higher priced products that can still cater kind of to the higher end market, but they also can cater to the lower end market in that sense. And then in terms of our valuation,